Friday as an indication of when or even if we're going to see any rate cuts this year. Minneapolis Fed President Neil Kashkari sitting down with CNBC International saying he thinks the Fed should take its time when it comes to cuts. Let's listen.
The U.S. economy has remained remarkably resilient. GDP growth has been strong, much stronger than forecast. Most people thought that we'd be in a recession toward the end of last year. That didn't happen. Instead, we had very strong growth. U.S. consumers have remained remarkably resilient. The housing market has remained resilient. So I'm not seeing the need to hurry and do rate cuts. I think we should take our time and get it right.
Well, joining me now to discuss is PIMCO's Rich Clarida. He is also the former vice chair of the Federal Reserve. Mr. Clarida, welcome back. It's nice to see you again.
You bet.
Let's cut through some of what Mr. Kashkari said. We should take our time and do it right. What does that mean?
Well, I'm glad to hear that from my good friend Neil Kashkari. I think it means data dependence. The data has been disappointing year to date, and so Fed rhetoric has moved away from highlighting a cut to we'll let you know when we're going to do that. I think there's a real case that we may not get any rate cuts this year. Although I think on balance, I'd probably lean in the direction of that. But I think it's pretty closely balanced call right now because of the inflation data.
Well, you told me last time you thought we'd get one cut. Are you rethinking that?
I think it's a closer call. I think than when I did the show last time. Again, it's going to depend on the inflation data. The calculation, though, Scott, is basically for the rest of the year, inflation needs to come in at around 0.2 per month for the rest of the year to keep it under 3%. That may happen, but so far we haven't seen it. So I think it's a close call, but I lean in the direction that we probably get one cut.
You do think, though, that the outlook that we get at the next meeting could be rather interesting in terms of what it shows, the so-called dot plot, which gives us at least an idea of what they're thinking in the room about the number of cuts we may get.
Exactly. So at the March meeting, which seems like a long time ago, the dot plot showed 3 cuts this year. It's certainly, I don't think, going to show 3 cuts this year. I think it's probably a close call between 1 or 2 cuts. I think my prediction is that the June dots will show 1 cut, and that actually may be a close call as well.
When people suggest that, good news on the economy is so-called bad news for the stock market, or it has the connotation of being bad news because it's going to, make maybe the prospects of inflation staying too strong for too long, rates elevated for too long. How do you and those in the room look at that? Do you sit back and you say, well, the economy is just too resilient? The data is too good. Can you give us some clarity on that?
I can. Again, it's a different committee than the one I served on, but certainly I gave several speeches as vice chair saying, the Fed likes it when people get a job. So the Fed's not targeting any particular rate of unemployment. It really does come down to the inflation data. Last year, the economy grew well above trend and inflation came down because of the improvements in the supply side. So no, the Fed is bad news. Good news for the economy can be good news for the Fed so long as consistent with inflation returning to target. The problem this year is not the real economic data. It's been that the inflation data has been stubborn.
But if you listen, though, to members of the committee like Mr. Kashkari, it leads you to believe that, well, the economy is almost too strong, or it's certainly stronger than we thought it was going to be. So, that raises the issue of inflation remaining stronger for far longer than we expected it to be as well. However, if the inflation is not necessarily being caused from traditional forces, like too much demand, and B, if you look at the stickiest part of inflation, or at least one part of it, which has been rents, and that's a tremendously lagging indicator. Is the Fed looking at the right thing and thinking about the right moves?
I think they are, but your question suggests that it is important to look into the into the details. You know, Scott, if we calculated inflation in the U.S. the way they do in the Eurozone, it'd be running at 2% right now, because over there they don't even try to do this owner equivalent rent calculation. So, yeah, I think the Fed is focused on the inflation data. It's focused on the labor market. I think the progress has been remarkable. You know, 2 years ago, inflation was 7%. It's now in the 2s. It's moving in the right direction. And I think it's appropriate for them to be in this data-dependent mode. So I don't have any big complaint with where they are right now.